And let's talk about gold prices, and we bring back in our guest for the second half of this hour, Aaron Smith of Superfund. And Aaron, before we left off, we were talking about resistance levels for gold prices, and you say that they've been broken through.
Yeah, sure. If you look at a gold chart and you connect the highs going back to March 2008, you see sort of a downward resistance line. That was clearly broken, after gold went above the $1,000 mark. You can see that it just shot right up to the 1050 mark. I suspect that we'll see a correction in gold sometime in the next 3 to 6 months. If that happens, I see that as an excellent buying opportunity. You should be buying gold for the long run and not trying to trade it, because ultimately gold is the only real currency in the world. There's only $5 trillion worth of gold in the world, so that's 155,000 tons. Compare that with the equity market, which is 46 trillion, which is, leveraged 3.6 times because of all the bonds, and then 590 trillion in derivative markets. There's so much leverage in the world today that hard assets are going to be the theme for the next decade. So hold on to your gold, particularly because gold has an 81% correlation to commodities since 1980. So if you own physical gold, you already have exposure to commodities.
Okay, so when you say correction, I guess investors and viewers out there want to know how big of a correction in gold is coming in the next 3 to 6 months.
Well, from a technical standpoint, I think I see good support levels at the 960 to 970 range if you look at the charts. It might go further if the IMF claims that they're trying to save the starving countries and starts selling gold. If the U.S. starts to defend the U.S. dollar by selling their gold reserves, it could correct even more. But in the long run, it's inevitable that I think gold will become much, much more expensive, and I'm saying $2,000 per ounce over the next 3 to 5 years.
Okay, do you think silver is a better buy right now? Because as you say, gold to silver, the ratio, at least at 59, is out of whack. So maybe in the next 3 to 5 years, silver might actually outperform gold.
Sure, it absolutely should. I mean, if you go back to the time of the Roman Empire and the time of Jesus, one piece of gold was worth 12 pieces of silver. So the ratio was 12 to 1. Today it's 59 to 1. That ratio is completely out of whack. I think it'll come down to at least 30 in the next couple years. If that happens and gold goes to $2,000 an ounce, that means silver will be trading at about $66 per ounce. From where it is today. So silver is an excellent investment to go along with gold. I see that China's been encouraging private investors to buy silver bullion for the first time in history. So I think this is an unprecedented opportunity. Just think of silver as leveraged gold. Once gold goes up, silver's going to go up more. When gold pulls back, silver's going to pull back more. But both metals make a lot of sense, and we do have long positions in both of those metals at this point at Superfund.
All right. Okay, well, Aaron, we're going to bring you back to talk about the rally in soft commodities as well, because sugar has been sweet all year long. We'll get more from Aaron Smith of Superfund after this break. Also, signs point to trouble for venture capitalists. That's where coming up next. In the meantime, if you have any questions, send them along. We'll see you after this.